All right, let's talk about taxes. It's something that affects pretty much all of us, but man, can it be confusing. Today, we're going to cut through all that noise and show you how the U.S. tax system actually works. My goal is to give you more confidence and, honestly, more control over your own money. So, let's dive in.
First things first, I've got a quick question for you. Let's say you're a single person. You made $50,000 last year, and that puts you in the 22% tax bracket. Does that mean you owe the government 22% of that entire 50 grand? Just think about it for a second.
The answer is a huge, emphatic no. And listen, this isn't just some minor detail. This is probably the single most important thing to understand about our entire tax system. Getting this one concept right can totally change how you think about your money and could literally save you thousands of dollars.
So let's go ahead and bust this myth wide open. The idea that you pay your top tax bracket rate on all of your income is easily the biggest and most expensive misunderstanding out there. Let's take a look at how it's really designed to work.
So the United States uses what's called a progressive tax system. And the best way to picture this in your head is to think of your income as water filling up a series of buckets. Each bucket is a different tax bracket, and each one has its own tax rate. As you can see here, your income doesn't just get dumped into one giant bucket. Your very first dollars start by filling up the 10% bucket. Once that one's full, the money spills over into the next bucket, the 12% one. You only start paying that 22% rate on the money that actually falls into that third bucket. And this is the key. You don't go back and pay a higher rate on the money that's already sitting in those lower buckets.
Okay, let's look at the actual math for that person earning $50,000. The first $11,600 are taxed at just 10%. Then the next chunk of income, all the way up to about 47 grand, is taxed at 12%. And look at that, only the tiny bit of income above that, less than $3,000 here, gets hit with that 22% rate.
So here's the bottom line. The myth would make you think you owe $11,000 in taxes, but the reality, it's just over $6,000. That is a massive, massive difference. Your effective tax rate, that's the actual percentage of your total income you paid in taxes, is really only about 12%, not 22%.
So what is that 22% number then? Well, that's what we call your marginal tax rate. All it means is that it's the rate you'd pay on the very next dollar you earn. It's super useful for making decisions, like if you're thinking about a raise or a side hustle, but it is not the rate you pay on all your income.
Okay, so you get the bracket system now. Awesome. But there's another piece to this puzzle that's just as important. The amount of your income that the IRS actually uses for that whole bucket calculation? Yeah, it's almost always less than what you actually earned.
Here's how that works. You start with your gross income, right? That's every single dollar you brought in. But then the tax code lets you subtract certain things. These are called adjustments and deductions, which we'll get to in a sec. What's left over is your final taxable income. And that lower number is what those tax brackets are actually applied to.
Now, one of the biggest ways people lower that number is with deductions. And you've got two choices here. You can take the standard deduction, which is just a simple fixed dollar amount anyone can take, no questions asked. Or you can itemize your deductions, which means adding up specific expenses like mortgage interest or state taxes. You get to pick whichever one saves you more money, and honestly, for about 90% of people, the standard deduction is the way to go.
But wait, there's something even more powerful than a deduction, and that's a tax credit. You have to see the difference here. A deduction just lowers the amount of income you're taxed on. So a $1,000 deduction, if you're in that 22% bracket, only saves you $220. But a tax credit? That reduces your final tax bill dollar for dollar. A $1,000 credit saves you the full $1,000. It's a game changer.
Okay, now that we've got the basic building blocks down, let's see how this all applies in the real world. Because whether you're a traditional employee or you work for yourself, well, it makes a huge difference in how you handle your taxes.
If you're a W-2 employee, things are pretty straightforward. Your job withholds what they think you'll owe in taxes from each paycheck and sends it to the IRS for you. But if you're self-employed, you're the boss now, and that means you are on the hook for figuring out and paying your taxes to the IRS, usually in quarterly payments. You also have to pay the full self-employment tax, which covers both your share and the employer's share of Social Security and Medicare.
Okay, so you get it now. You understand brackets, taxable income, and credits. So now, for the best part, putting that knowledge into action. Let's run through 5 totally legal and really effective ways you can lower your tax bill.
Let's hit these quickly. First, retirement accounts. Putting money into a traditional 401k or an IRA is a classic for a reason. It lowers your taxable income right away. Second, health savings accounts, or HSAs. If your health plan qualifies, these are amazing. They have a triple tax advantage.
Third, tax credits. Do your homework and claim every single one you're eligible for. Remember, that's dollar for dollar savings. Fourth, for all my self-employed folks, track every business expense. Every little bit helps reduce your taxable income. And finally, if you're an investor, look into tax loss harvesting. It's a smart way to use investment losses to your advantage.
And of course, I have to say this, and it's really important. This has all been for educational purposes, just to help you get a handle on the system. Tax laws are incredibly complex, and your personal situation is unique, so please always talk to a licensed tax professional for advice that's actually tailored to you.
So there you have it, a much clearer look at how your federal income taxes actually work. You've busted the biggest myth, you've learned the lingo, and you've seen some real strategies you can start using. So the question I'll leave you with is this. Now that you have this knowledge, what's one thing you're going to do differently? Thanks for tuning in.